Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what has happened in the world of finance, investing, and markets. On today's podcast, I'm happy to welcome Michael Howell, who's the founder and managing director of CrossBorder Capital. So, Michael, thanks for joining the podcast today.
Great pleasure, Anthony. Thank you.
So, I'm going to keep the first question very broad, and then I guess we can go with it where it goes. So, why liquidity? Why are you focusing on that?
Well, the short answer is that money moves markets. I think that must be evident, certainly over the last 2 or 3 years. I mean, it's been the dominant factor, but actually it's been there for decades. It's always the major factor behind asset market movements. And ultimately, when money or liquidity shifts from financial markets into the real economy, it determines the pattern of world economic developments. So it's the most important factor. Money moves things, but it moves markets above all.
Yeah, that's a great way to look at it. So, I guess why does it change? It's very another basic.
Okay, well, I think the first thing to do is to sort of maybe define some terms. I mean, yeah. I'm using the term liquidity rather than money. I mean, the reason for doing that is that money is sort of the kind of domain of economists. And economists define money in a particularly let's say, awkward or old-fashioned way, which is not really relevant to the modern world. But they look at things which are numbers, sound a bit like motorways, M1, M2, etc. The problem with that definition is that it basically restricts one's purview to looking at retail money in high street banks. Now, if you think that that's where the financial system begins and ends, well, I'll come quietly. But the reality is that actually there's a whole proliferation of other financial entities, other institutions that can create credit, both within the domestic economy and internationally. And we need to take account of those. And our definition of liquidity is really a credit measure that, if you're familiar with balance sheets, it's a measure that looks at the left-hand side, the asset side of the balance sheet. It basically is a way of understanding sources of money, sources of liquidity in financial markets. We put a particular financial focus on what we're doing because, as it happens, we're interested in financial markets. So think of it as the amount of liquidity or money that is flowing through, able to be spent, that is flowing through global financial markets.
Yeah, interesting. And that's why, I guess, if there's lots of liquidity, if there's not a lot of liquidity, that's where we see these potential shocks or even like the massive bubbles that we've seen essentially in the past few years.
Exactly. We've seen it so many times. And when we saw it, going back in the 1980s in Japan, where there was a huge bubble, then blown up in Japanese financial markets. You saw it around the time of Y2K, the millennium bug, so to speak. I mean, that was the time when central banks injected lots of liquidity in anticipation of bad economic risks through the pass-through to the millennium. We saw it again ahead of 2008, 2009, and we've seen it again, in the wake of the COVID crisis. So it happens all too frequently.
Yeah, definitely. And, there's lots of, I guess, measures that people use, or sort of, I guess you could say, pieces of data that people use to analyze markets, inflation, you could say PMI, or GDP growth, all these other factors, consumer spending. Is liquidity, I guess, linked to that, or is it its own thing?
Well, yeah, exactly. Yeah. It's a stage before. I mean, these things are derivative. And, what you've got to do is to think of the sequence here. The sequence is very much that liquidity is created, and it's either created directly by central banks. They are, in fact, increasingly playing, since in the last 10 years, a bigger and bigger role, and notably the Federal Reserve in the US. Then you've got banks, or what are called shadow banks, which are doing, if you like, wholesale banking. Those entities can create credit. Those are the sources of liquidity. They may be embroidered on top of that by cross-border capital flows coming in, but all these are sources of money to be spent in financial markets. That money drives asset prices higher. It will spill over first from let's say fixed income and equity markets into real asset markets like housing. So housing is a derivative of this as well. And then ultimately will move into the real economy. As it hits the real economy, economic activity will begin to go faster. And then if there are capacity problems, inflation will pick up. And that's pretty much what we've seen this cycle. The big difference to note between this cycle and the 2008-9 global financial crisis cycle was that in the wake of the GFC, central banks injected lots of liquidity into financial markets, but it did not shift from financial markets into the real economy at that stage. It stayed largely vested within financial assets. And so you got asset bubbles, blown up after the GFC progressively through the last decade. It didn't really impact real economies very much, but the COVID crisis changed that. And what you saw at the time of the COVID crisis was a dual effect. Central banks injected lots of liquidity into markets, as they had done before in the wake of the GFC. But on top of that, governments, through their furlough programs or income transfer programs, income support programs, actually pushed that money into retail bank accounts. So, the likes of you and I actually had more money to spend. And that then drove the real economy faster. And then we've seen the recent clash involving, energy supply problems, and hey presto, we get inflation.
Yeah, definitely. So if we take a step back, would you say there was a cycle between 2008 GFC and COVID crisis, or was that just sort of one big increase of?
Well, yes. I mean, there were periods, depending on which economies you look at, where there were very clear examples of liquidity creating bubbles. China was a very good example in the years immediately after the GFC. So we're talking about from 2009 through to probably 2013, 2014, when there was a big bubble blown up in Chinese asset markets. And then we saw the beginnings of a significant squeeze in China, really from around about maybe 2016 through 2017, 18, when Xi Jinping embarked on an anti-corruption drive. A lot of money fled from China into US assets at that stage. Now, what you saw was a very clear gyration in the Chinese markets. I mean, they actually haven't recovered really since, but everyone is anticipating another upleg coming in China as the People's Bank have to do something about this damaging COVID lockdown that is adversely affecting the Chinese economy as we speak.
Yes, I guess one of the challenges is understanding where this liquidity will impact in, as you mentioned there, will it be in 2008, afterwards financial markets in China? I guess that really influenced commodities as well as real estate there and other real assets. So it's not only understanding how much liquidity there is, but what impact it will have on our world and markets in particular.
Correct. I think one has to look at, maybe the sources of this liquidity. And I think it's, a question of saying that maybe if one puts it very crudely or maybe very simplistically to say that the Federal Reserve controls the valuation of the market, in other words, the PE multiple, that's largely the result of what the Federal Reserve does. But then the E is something different. It's much more the People's Bank of China because of China's large footprint in the world economy. China can control world GDP growth, and it does, and as you cited, commodity prices. And that has a very big bearing on the E that a lot of corporations around the world get, their earnings number. So you've got the two central banks that are essentially neatly dividing up the pie. One is looking at valuation, one is looking at earnings. And what we've had for the much of the last 12 months or so is that both of those central banks have been tightening, the Federal Reserve pulling down valuations on markets, and China crimping liquidity and adversely affecting the E in the earnings number. So you've had low economic activity and you've had depressed valuations. What we would hope is that in 2023, we see a reversal, maybe first from the People's Bank of China, injecting liquidity to try and get the Chinese economy restarted after this damaging lockdown, and then ultimately from the Federal Reserve as they begin to win the battle against inflation, and they can start to push more liquidity back into markets. Now, it may be, and I suggest I throw this out as a sort of bone to the bulls, is that what you may be seeing right now is that the Federal Reserve is beginning the process of switching away from QT, quantitative tightening, towards a QE, a quantitative easing process. And it's not because they feel the economy deserves it yet, but it's much more for financial stability reasons. And the shift towards financial stability focus has really been driven by what happened in the UK gilt market in September after the, let's say, very poorly presented Truss budget. The gilt market sold off, as we know. Sterling took a major hit. But the key point to note here is that for central banks or policymakers globally, what really spooks and unsettles them are problems in the sovereign debt markets, because that's the heart of the financial system. And what you saw in the UK gilt market was unprecedented. Gilt prices, in other words, government bond prices, fell precipitously, yields spiked up. That would have been a major hit to the cost of servicing government debt in the medium term if it persisted. It would have derailed UK fiscal plans tremendously. And that is a wake-up call for central bankers worldwide. And I would suggest that that lesson has been learned. If it has not yet been learned by the Bank of England, it's been learned by the Federal Reserve. And so the Federal Reserve is, in our view, is beginning to make this division now between monetary policy for economic cycle reasons and monetary policy for financial stability reasons. And it's the financial stability reasons which are coming to the fore now, because what you have in the US markets is maybe a similar lack of headroom in terms of liquidity available for the US Treasury market. And the US Treasury market is the most important financial market worldwide. So as we speak, we may be seeing the very first signs of the Federal Reserve beginning to crack here.
That would mainly be through QE, I guess, and then...
Well, it would be a form markets, of QE. Yeah. Whether they call that a QE is a moot point. I would rather suggest they won't call it QE, but it will de facto be a QE, and it may be there may be smoke and mirrors involved in this, and it may be that there are things, maybe somewhat arcane policy lines that they're suggesting, such as what's called treasury buybacks, where they basically buy back illiquid treasury issues, bond issues that have gone stale, if you like, refresh them with new issues which are more liquid. Or it may be things like operating at the front end of the yield curve. In other words, issuing a lot more bills into the market rather than coupon securities like notes or bonds. Those are subtle twists, but at the end of the day, what they may well mean is that more liquidity gets into American money markets, which is really what matters.
Are there any other countries, I guess, that you're keeping a big attention on or analysing?
Well, I think they're all. I mean, in truth, everyone's doing it. I mean, the Bank of England has shifted away from QT towards a QE. They acknowledge that, but they again sort of fess up to say that this is for financial stability reasons. So it doesn't really matter. It's a short-term move. Well, we'll see about how short-term it is. The European Central Bank has significantly scaled back its original plans for QT already a number of times this year. So you're looking at a much more benign profile for QT in the Eurozone. We know that the Bank of Japan is persisting with a QE program. I mean, it never deviates from that. The yen has obviously taken a hit through this year because of that, although it's latterly strengthening again. And if you look at the People's Bank of China, I mean, it's almost anyone's guess as to what's going on with Chinese policy. But looking at their actions in markets, it seems to be very clear that they're pushing more liquidity into Chinese financial markets. And in fact, the last 6 weeks have been some of the more buoyant in terms of liquidity injections that we've seen for maybe 18 months. So there were some very positive straws in the wind there. So the reality is that if you take a look at 2023, it's likely that liquidity conditions globally will be improving. We are, at the moment, at the point of maximum tightness in markets. And given the fact that markets always price in changes, not levels, the fact that we may be getting an improvement next year could be taken as a positive factor for many financial markets. And maybe that's what they're doing right now. So I think there's a lot of evidence that we could be seeing some inflection. I mean, the danger is are there any skeletons in the cupboard? More crypto pain, or are there issues in the real estate markets? When we've seen problems with Blackstone and their real estate private equity real estate holdings, they've got illiquidity problems that may well extend. I mean, around inflections in the cycle, you often get bad news. That's for sure. But all I'm saying is, from a policy perspective, we probably are at maximum tightness now, and things are going to get better.
And will that be the challenge in the next few months until, I guess, we see those changes and that increase in liquidity, where there could be these inflections?
Yeah, exactly. And I think the thing to remember is that liquidity is a leading indicator. It tends to lead financial markets by around about 6 months. It tends to lead real economies by nearer 12 to 15 months. So, you know, the tightness that we've had in the system up to now is still going to impart a negative effect on real economies over the next year at least. So, you know, 2023 may not be good for real economies worldwide, but it's so often the case that, you know, weak economies often have strong financial markets, and vice versa. Strong economies tend to have weak financial markets very often. That's the paradox that it's very hard to get one's head around often, but that's how the system works.
Yeah, and I've seen one of your charts where it's sort of like comparing to the business cycles, and I guess it's the classic peak trough. So you'd say we're
Correct.
at the moment we're at that trough
Yeah.
potentially, and then we're going to start seeing increases ideally, but it might not, as you mentioned there, it might not get into the actual finance or real economy.
Yeah, there'll be liquidity coming into financial markets, but you know what we're looking at is a sort of desert, and it's going to take, you know, a while to extend the analogy before you see green shoots appearing.
And what would you be looking to see before, I guess, you mentioned there 6 months, but is there any other indicators or things you'd be looking to see before maybe?
Yeah, I think there are several things that one can look at. I mean, the most straightforward thing to watch, rather bizarrely, and I hesitate to say this is not an investment recommendation, is to look at cryptocurrency prices. I mean, they are the ultimate liquidity sensitive asset class. So if you start to see, you know, things like Bitcoin picking up in price, you know, noticeably substantial increases, then you can be reassured that liquidity is coming back into markets. So I think that's one box to tick. I think another one would be to look at the yield curve, the slope between, let's say, 10-year. You've got to look at the US Treasury market, of course, here. Look at the slope between 10-year treasuries and maybe 2-year treasuries, something like that, that gradient or that spread. If that goes positive, it's very negative right now, but that would be a sign that liquidity is increasing. And a third sign would be to look at the value of the US dollar. If the US dollar is beginning to roll over, and maybe associated with that, the price of gold begins to go up, those are indications that liquidity tends to rise. Now, I think that it's worth spelling out the fact that gold is not, maybe dispel a misnomer or misunderstanding. Gold is not an inflation hedge. In other words, a high street inflation hedge. It never really has been. It's always been a monetary inflation hedge, and it tends to go up in value when central banks are increasing monetary inflation. It will go down in price when central banks are creating monetary deflation. In other words, they're reducing the amount of money in the system. And that's really how gold moves. Now, if those monetary inflation and deflation episodes coincide with high street inflation, then sure, gold will be a good hedge. But that's not necessarily the case. And what we've seen in the last 12 to 18 months are some big cost inflationary hits from oil prices, which, you know, gold has got no way of actually matching. So it's moving much more with monetary inflation. And if central banks come in and start printing more money, in other words, more QE, the gold price will go up as well. So these are three and very straightforward signals that will tell you that liquidity is improving or not.
What do you think would happen if, say, the Hawks, I guess, took control and they were able to continue with what they're doing with tightening because of concern of inflation? Do you feel like that would be, yeah, obviously very detrimental to the financial markets and the real economy?
Yeah, I think that's a very good question. I think that's probably, you know, a key question to address. I think what you're seeing, and this is my interpretation, so, you know, clearly there's a health warning involved in this, but I think what you've got going on is a division between, if you like, financial stability policy and conventional economic policy. And I would suggest that what the central banks are doing is they're using their balance sheet, in other words, liquidity, for financial stability reasons, and they're going to use interest rates to try and control the inflation problem. Now, what that means is that you're likely to see interest rates higher for longer, maybe rather than higher and higher, right? So I think they stay up and they plateau for a long time. So I don't think we go back to the very low interest rate regime for some time. But I think the balance sheet is a very different vehicle, and that will be used opportunistically when necessary to basically improve liquidity in financial markets. Now, I think that the liquidity in financial markets has already got down to dangerously low levels, which is, I think, what you're seeing in the sovereign bond markets. Okay, and as I've said before, this is a red light for central banks and treasury ministers around the world. They do not want the sovereign debt markets to be derailed at all costs, right? So if that happens, inflation fighting is off the table. They'll focus on the sovereign debt markets without any question. Now, I think we're close to that point. I think that's what the Federal Reserve is basically engaged in looking at. Now they want to improve the integrity of these markets, and therefore they're going to use their balance sheet more and more. Now, if they don't, if we're wrong, it's possible, entirely possible we're wrong, and you get further QT, okay, in other words, significant balance sheet shrinkage alongside higher interest rates. So there's a real danger of seeing another episode of a refinancing crisis. Now, one's got to think about what's happening in financial markets with that backdrop. If you pick up an economics textbook, what it tells you is that what finance is all about is interest rates. Okay, that used to be the case, and it's certainly the case if the financial markets are operating as new financing mechanisms. In other words, that you're a corporation or a business, you want to raise new capital, you come to the financial market. What really matters for you is the interest rate you pay, okay? Because you will compare that against your expected profit rate. And if the interest cost is less, then you may well borrow to expand. Fair enough, okay? The trouble is that that's not the world we live in anymore. Okay, there's not very much capex going on. Most of the capex that is going on is occurring in the East, in China or Asian markets. In the West, we've had very little capex for the last couple of decades. The only capex that's going on is really replacement stuff, which doesn't really, interest rates are not really the question there. What the financial markets have turned into instead is not new financing mechanisms, but refinancing mechanisms, refinancing this whopping great debt load that we're sitting on. Now, how do we get down this road? How do we make this big error of taking on so much debt? I think it's very simple that the central banks made a big error 20 years ago. And what they basically did was, first of all, or what the policymakers, let's say, first of all did, is they let China into the World Trade Organization without any controls. So China exploited this to its advantage. It created, and let's say, in truth, to our advantage initially, it created cost deflation because costs were very low in China, and it could dump a lot of goods into the world markets at very low prices. So needless to say, you got a deflationary hit to the price level in the West, and what that caused was falling inflation rates. Now, the central banks worried about this because they thought what we're looking at here is falling high street inflation, but it's actually a monetary deflation. And we as central bankers should be fighting monetary deflation because we know from history in the 1930s, it was hugely damaging. So they misread it. It wasn't monetary deflation, it was cost deflation, right? And they'd ignored the supply side effects of allowing China to come into the world economy. So what they did is they cut interest rates. They shouldn't have done that, but they did. They cut interest rates. What do interest rates do? They incentivize us all to take on more debt. And so as interest rates started to drop, more and more debt was accumulated. Now, the problem with debt is that it's a dead weight on economic activity, and it tends to crowd out productive investment. So the more debt there was, the slower the underlying productivity of economies and the slower the growth rates, which meant the central banks were even more enthusiastic about cutting interest rates more. And so you got this vicious cycle of this huge debt load. Today, there is $350 trillion worth of debt in the world economy, right? With an average average lifetime of 5 years, which means that, simple maths, $70 trillion of debt has to be refinanced every year. So what you've got, or what you have to have, is balance sheet capacity to do that. You've got to be able to roll over the debt position, the new debt to get new debt to replace the 70 trillion that's maturing. So you need liquidity and balance sheet space. The only way you get that is by the central banks creating liquidity and providing the means to expand the financial sector balance sheet within each economy. Now, if you draw a comparison, that 70 trillion compares with 10 trillion of new capital financing in the world economy. So financial markets are 7-to-1 refinancing over new financing. And that's what the central banks don't understand. That's what the textbooks never tell you. And that's the reality. In a world where you've got refinancing, liquidity is critical. If that liquidity is missing, you will get refinancing crises. Look back over the last 2 decades, every financial crisis you've seen has been a refinancing crisis. And we're going to get more if the central banks don't wake up.
So I'm assuming that you believe that a lot of these economies are going to go, or I guess central banks are going to go the way of Japan, and most governments will be actually having to buy their own debt because there's not that liquidity available.
Well, I think you make a very astute point that that Japan is the leader here. That everything we've seen invented in Japan has been passed to other economies. Whether that is negative interest rates, whether that's deflation, whether that's aging demographics, whether that's yield curve control, whether that's quantitative easing, made in Japan first and then exported to the rest of the world. And the reason being is that Japanese demographics are about something like 12 to 15 years ahead of most other economies worldwide, for reasons best known to the Japanese, but that's the reality. And so what you've seen in Japan is now basically affecting everybody else. Look at the Eurozone, look at Europe. Europe's got very bad demographics. Britain and the US, fortunately, are not really in that same camp, but it ain't great. But they're probably the cleanest shirts in the laundry. That's the reality here. But what you have coming in the next 5 to 10 years are just whopping increases in mandatory spending by governments. So these are things like on social security, welfare payments, health, education, defense, all these things which governments have to supply, aside from their discretionary actions, are just absolutely mounting hugely in the next 5 to 10 years. How is that going to be paid for when you've got working populations, because of demographics, which are shrinking? So the tax bases are falling, and we're already hugely overtaxed. So it's just going to get worse. And the only route back here is for the central banks to come in and start buying up some of the debt. So the Japanese understand it, and therefore what they've done is to fix the problem is to do yield curve control. So just watch out; it's coming to a high street near you soon. Yield curve control is something we're all going to understand pretty fast.
Yeah, and I guess the risk is that you could say Japan has hardly experienced any inflation for decades.
You can't create it because you've got an aging population.
But would you say that was maybe linked to what you were mentioning before about China having access to?
I think it's.
Or do you think that's maybe a stretch?
Yeah, I think it is. I think you've got to say that geographically it's it's the neighboring economy, and so you'd expect the big productivity increases that China has seen and the falling costs to have a negative effect on Japan. That's inevitable. But I think the other thing that you've got on top of that is that you've got aging demographics. And the fact is that older people don't spend money. Okay. It's younger people that spend money. And I think you just got to go back to, when I was, when I was in my, early 20s in the 1980s, I mean, eons ago, people then faced really high interest rates. I mean, interest rates gone up to, at times, serious double digits, 20% or whatever it may be, interest payments a year. Just think of that, right? But you still had to buy a house. You still had to furnish a house. And the fact was that you had to do this. So you did. Okay. So it was tough, but it happened. And that's the fact is, if you've got young people in the economy, they basically have to spend because they've got to live and procreate and create families and structures and whatever else. They need to spend money. Older people don't. And if you've got aging demographics, it has a huge impact on economic development. Absolutely clear. Japan has shown us that. Eurozone is showing us now. Look at the Italian economy. It's catching up with Japan pretty fast here. Very significant demographic burdens. But this is true right across Europe. Britain, fortunately, is not so bad, and America is in a better position still.
Yeah, it's fascinating. I can't remember who said it, but it was talking about dependables and how the more dependables there are. You look at the 70s, so that's when we saw the high inflation. But then, as you said, Japan hasn't experienced that, so it'll be interesting to see sort of where that goes. So yeah, Michael, thank you so much for your time. I guess my last question is, what is one message you'd like people to take away from our conversation?
Well, the one message is liquidity is the most important thing to understand in financial markets. Central banks increasingly control that. And among the central banks, the two big ones are the Federal Reserve in America and the People's Bank of China obviously in China. And those are the actions you've got to watch pretty closely. That's what's driving the whole system. So that's number one. And then number two is that make no mistake that what these governments and what these policymakers really want is for us to buy their debt. They need to sell that debt because effectively they're committed to spending a lot of money. Their taxes are not going to be raised in the way that they want. So they're going to have to basically sell that debt in some way. So, watch out for manipulative means, whether it's financial repression or whatever one calls it. But, you've got to be alert to how you hold your assets in the future and looking at things that are not only going to be, safe against, maybe potential inflation, but also safe against government taxes and the voracious appetite or rapacious appetite of governments to try and steal our money.
So I guess I'll go one more question. What is, in your opinion, do you see as those assets that would protect you against that?
Well, I think realistically, one's got to think about diversifying internationally. So I think that's one point, and I think that at the end of the day, the question to ask is where is it going to be less likely for governments to actually steal that money? Now, you'd probably say the US looks fairly safe, which is why the dollar is always regarded as a safe haven. The second thing to say is that maybe you can hold things like gold, where it's very difficult to actually, for anyone, if you hold physical gold, clearly you've got it, right? And the other one, which is, again, I hesitate to use this as an investment advice, but look at cryptocurrencies. Why are cryptocurrencies so popular? It's because they're outside of government jurisdiction. So that's another, certainly so far. So that's another thing to start thinking about. But one's got to think more and more about keeping money out of the grasp of governments.
Yeah, that's a great point. So, Michael, thanks again for your time. If anyone wanted to hear more about the work you do, I know you do quite a few podcasts as well. Where would the best places for that be?
Well, you can find us on our website, crossbordercapital.com. Twitter handle is crossbordercap. Those are pretty good sources.
Perfect. I'll put that on the description below. But yeah, Michael, thanks again.
Great. Thanks for your time. Thanks, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.